Exxon Mobil and BP, the latest to report steep earnings drops as oil stays lower for longer. Shares of BP sank after the British oil major reported a 91% quarterly plunge in profit. It made just enough to cover capital expenditures, but not enough to cover the 7% dividend, borrowing to do so. Even so, management asserts it has enough cash to maintain that payout through 2017, adding that it will lay off another 7,000 workers, or nearly 9% of its staff, over the same time period. Exxon Mobil, which analysts consider the defense trade within energy, held up relatively better. The U.S. oil giant posted a 58% drop in earnings, the first time quarterly profits dipped below $3 billion since 2002. Exxon slashing spending by 25% this year, a substantial cut for that company. But again, the dividend remains the top priority, even as management suspends share buybacks for the first time in 15 years. Analysts say it makes sense to fervently protect those payouts, even as those companies take a hatchet to investments.
I think for a lot of companies, Exxon as well as others across the space, the growth investors have largely headed for the exits. And I think protection of the income investors is something that's first and foremost for a lot of these companies.
Still, shares of Exxon Mobil tumbled in trading as U.S. crude once again fell below $30 a barrel. Exxon and BP's results come on the heels of Chevron, which reported its first quarterly loss in more than 13 years. Later this week, Royal Dutch Shell is also expected to report that earnings fell by roughly 50%, and ConocoPhillips is expected to post a loss. For Nightly Business Report, I'm Morgan Brennan.